All right, good afternoon, everybody. My name is Bobby Rains. This is the Investors Observer Members Only Workshop. Thank you all for coming. Let's take a look at our agenda here. We're going to look at some charts. We'll talk about what else is happening in the market, look at sectors and industries that are hot right now. And then the rest of the presentation is member-driven content. Questions, site demonstrations, anything that those of you who are hearing my voice right now are interested in, you can throw it in the question box and I will get to it either as I go or during that period at the end. All right, let's look at some charts. So, yeah, we have gone down again since the last time we had one of these presentations. New lows, in fact. We were, I don't know, back in here somewhere the last time. Yeah, so new lows, although today wasn't quite as bad. We'll see what tomorrow brings with the CPI report, which we'll talk about a little bit coming up. It's interesting, the S&P 500 has set new lows. The NASDAQ has also set a new low. The S&P is kind of hovering right around this area where that hit a couple weeks ago, whereas the NASDAQ is decidedly below that. We'll see a little bit more of that when we look at our comparison of the S&P 500 and the S&P 500 equal weight. But essentially, the tech stocks continue to do worse than sort of the rest of the economy. Interestingly, the Russell has not made a new low since back in June. A lot of times small caps tend to be sort of the canary in the coal mine on the way down, and they're certainly down from a recent high, but not a new low since June and not actually a new low since last month, unlike the other two. So that's kind of interesting. It's, kind of too early to say that it means anything, but it is kind of interesting to see the small caps sort of outperforming on a relative basis over, the last couple of weeks. All right, so the S&P 500 versus the equal weight. Again, this spread has gotten relatively wide. And the reason I like this chart is the top of the S&P 500, as it's traditionally tracked, is market cap weighted, or the whole index is market cap weighted. And so those big stocks at the top, your Apple, Google, Tesla, they have kind of an outsized effect on the rest of the index, whereas the equal weight weights the all 400 or all 500 stocks the same, and so so you don't get some distortion from the big one. So this just shows that like those big tech stocks are down more than the sort of average stock in the S&P 500. All right, and again, we've seen that some number of times on the way down, right? Like the beginning of this year, the big stocks at the top were outperforming the equal weight, and they have underperformed for most of the year, except for during rallies. They tend to do a little bit better. All right, growth versus value is a similar story to the sort of ultra large caps versus the small caps. It's another way to look at sort of tech versus other stuff. All of these things are sort of telling the same story, right? Like value, again, right, like hasn't set a new low with this most recent downturn, whereas the growth stocks definitely does. And we'll talk about this a little bit when we look at the sectors and industries that are hot right now, which I think is the next slide. It's really just an issue of, right, like tightening monetary policy and a lot of things that were priced very high on the promise of future growth are getting sold, whereas, businesses that are producing positive earnings today are not getting sold so much. All right, so let's look at those sectors and industries that are hot right now. It's kind of an interesting picture here. Energy is the big story there is energy prices, the war in Ukraine, things like that. Thermal coal is a little bit of a weird one because it's not a particularly big piece of the economy. Oil and gas, for that matter, aren't nearly as big as they used to be. But energy prices remain relatively high. These stocks have done relatively well over the last several weeks. Utilities, again, it's a little bit weird to see utilities doing well in a rising rate environment, just because utilities tend to be a little bit leveraged, but they also, tend to be profitable. They tend to pay dividends. So it's not really surprising in an environment where people are looking for stability and income as opposed to betting on growth. Consumer defensive is the next one. This is another, cash today over cash tomorrow sort of play, right? Like confections is things like Hershey's, maybe Kraft, what's it called now? Mondelez, is stuff like that. Discount stores, food distribution. These are both defensive stocks in terms of investing. If people worried about a recession, these are the kinds of places money tend to go. Also, these businesses tend to be profitable, and they may not have the promise of making a better tomorrow, like some tech companies or something in the some of the biotech companies. But they're profitable today, and they don't seem like they're going anywhere. Probably, right? Like, I don't know if anybody saw Pepsi's earnings this morning. Pepsi did pretty well, and their guidance was pretty good. Those kinds of things are doing well right now. So these are all three of these tend to be relatively defensive plays. Energy can be a little bit of a wild card there, because a lot of time if you have a recession, energy demand and prices goes down. Obviously, we have a little bit of a different situation going on right now, but utilities and consumer defensive are classic, where to put money if you're worried about a bear market kind of stocks, or worried about a recession kind of stocks. So that's not super surprising. What is interesting is the industrials and basic materials, right? Basic materials and energy are both things that you expect to need more of in a growing economy. You don't necessarily expect them to do great in a recession. Obviously, we have kind of a different situation going on right now, but it's interesting to see them here. And then, the industrials is also a bit interesting in terms of infrastructure operations, which is a lot of things like ports and other things like that, consulting services, and industrial distribution. A lot of this is, like the kind of things you would expect to be doing well in a healthy economy. And again, basic materials, agricultural inputs, that's things like fertilizer, I think some seeds and stuff like that. Coking coal is used in making steel, lumber and wood products. A lot of that is like home building and renovations and things like that is where a lot of your lumber and wood products go. So it's interesting to see these stocks doing well at the same time that these stocks are doing well, while all the talk is about, we might have a recession, and people are also starting to worry about real estate, although I'm not really, as I'll talk about on the next slide. You can find this data any day that you want by going to the sector and industry page. That's just looking at the short-term technical score, what I just showed you, right? Here's those top 5 sectors right there. And the industries are here. You can click through and see a full list of the industries and also the top stocks in the sector. And you can see these for any of our 7 scores, right? I like the short-term technical score for this presentation because it gives you an idea of what's been doing well over the last few weeks, as opposed to some of the other scores, which typically have a little bit of a longer horizon, or the sentiment score, which tends to have a significantly shorter one. All right, so what else is going on? It's still Jay Powell's market, right? We're just trying not to get killed in it. Inflation and employment data and the Fed's response are the big drivers right now. Last week's big drop after the jobs numbers is right directly tied to the Fed messaging about wanting to see a less tight labor market, right? Like you don't get a big drop in the stock market when you get better than expected monthly employment figures unless people are worried about something like this, right? Like what people are actually worried about is the Fed is going to keep tightening. Because otherwise, right, like more jobs than expected is good news. So those are the things that people are really paying attention to, and that's what they're trading on. So we get ourselves into a little bit of like, you know, a number that comes in a little hot or better than expected under normal circumstances can push stocks lower, and you know, something that shows prices falling, you know, unemployment rising a little bit could actually be good for stocks, sort of in this environment. The economic data, though, has generally been pretty good. The jobs data, like I said, better than expected. That implies that more Fed tightening is ahead. The minutes that came out today, they talked about sort of trying to calibrate the pace of continued tightening so that the you know, so as not to hurt the economy too much. But as long as they keep getting better than expected jobs numbers and the unemployment rate actually moving lower, that's one sort of green light that they can look at and say like, hey, we can keep doing this, and the economy is not is not slowing down as much as we're worried about. So we can keep doing this and not cause a severe recession. Inflation is showing signs of moderating. It's not falling as quickly as certainly the Fed would like, but it is showing signs of I'll say, moderating. Prices are actually falling in some areas. The increase is slowing in other areas. So that's sort of encouraging. CPI is tomorrow. The producer price index was today. It came in a little bit higher than expected. Not as much of the producer price index flows through to the CPI as you might expect. So it's possible that that could come in, you know, lower than expected would be better in this kind of a market. So it's possible to have a miss on one side and a beat on the other in terms of that consumer and producer price index. We'll you know, see what happens at 8:30 tomorrow. The housing market remains sort of broken, but a crash seems unlikely. I think the slowdown in sales is probably actually sort of healthy. If you look at inventory numbers and things like time on the market, those things were just very, very, very low. And now you're seeing things stay on the market a little bit longer. The inventory, you know, how many homes are for sale is sort of rising. That tends to be a healthier market. It does mean that, you know, some home prices might not go up as fast. It may mean that in some cases, a house might be valued a little bit less than it was not that long ago. I wouldn't be super happy about these developments if I was in the home flipping business. But everybody who wants to live in a house is essentially short housing until they buy a house. And then they're functionally flat, the housing market, right? Like, you need a house. If you're going to sell your house, you're going to need to buy another one or find some other housing situation somewhere, right? So this isn't really a problem, and I don't think we have. First of all, the credit quality and the mortgage quality is much better than it was in 2007 and 2008, and I don't think we have nearly the number of, you know, relatively small time speculators in the market. And also, household balance sheets tend to look much better right now. Also, all those things are reasons that I don't think we're going to have a housing crash a la 2008. You know, if I bought a house last year and I was trying to sell it this year, I may not be super happy about this kind of housing market. But more generally, I don't think we're really in for too much of a problem here. I think, you know, mortgage rates are going up. Some prices might sink a little bit, but except for people who are, you know, trying to turn over a house relatively quickly, I don't think it's anything to worry about that much. Earnings season is right around the corner. We've had a few pre-announcements, and they've all been negative, which is not really surprising. I mean, anytime anybody comes out and announces sort of their earnings results early, it's a little bit surprising in terms of that company in particular. But pre-announcements are usually bad because a lot of what companies are doing there is trying to manage expectations, right? They'll come out and say, oh man, our projections were way off. It's going to be bad this quarter. And then they'll turn around at the actual earnings report and, sometimes the revised thing is right on. Sometimes they're like, oh, actually it was a little bit better than expected. But what they're really trying to do is not drop a big surprise on the market with the actual earnings report. They're trying to get out in front of it a little bit and manage expectations. And so it's not surprising that all the pre-announcements are bad because virtually nobody has ever, I'm hard pressed to think of a case where somebody has pre-announced a huge earnings beat. It just doesn't really happen. Right. Nobody's ever trying to get out in front of good news so the market doesn't have a strong reaction, right? Like everybody wants their stock price to go up. The other thing we have is because of some of those pre-announcements and some other things, there's been a lot of lowering of estimates, things like that. So theoretically, things could be set up for relatively positive earnings season. However, one thing that I try to look at every 4 times a year during earnings season is sort of how the market reacts to news. Like sometimes it feels like the market is looking for good news and somebody can come out and say, yeah, our earnings weren't as good as expected, our revenue wasn't as good as expected, and this quarter is also looking pretty bad, but for the next full year we think we're going to get it back on the right track. And the market will be like, hey, they think they're going to get it back on the right track. Yay. And the stock goes way up. And there are some times where, a company can come out and beat and raise earnings and mention some weakness somewhere. And the whole market just grabs onto, oh, hey, there's some weakness somewhere, and everything gets punished. So far, the sort of mood of the market, if you will, seems to be to sort of punish weakness more than reward strength. We'll see if that holds up for the rest of the earnings season. That, just because we're here now doesn't necessarily mean that will hold up for the next several weeks as the earnings reports start to roll in. But we'll see. And that is kind of, I think it's very vibesy and hard to quantify. But in terms of trying to trade earnings season or make sense of it, that's sort of like, how is the market reacting to things and which things tend to be getting, bought or sold tends to be a better indicator to me of how the earnings season is going, or at least how stocks are doing during earnings season, than the actual number of like beats or misses. Some other things that are going on that I think the chip export controls will be interesting. That news came out essentially over the weekend. It's unclear to me what some of those things mean. There were some reports in the Wall Street Journal this morning about some of the memory chip makers halting production in China. I have some questions about, if you say, okay, these certain kinds of chips aren't allowed to be exported to China, does that mean that if I'm, say, Hewlett Packard, I can't, make those chips in Taiwan, ship them into China to be put into computers and then ship those computers out? Like certainly I can't sell them into the Chinese domestic market, but am I not allowed to take them into China at all? I don't know. I'm not sure that anybody knows based on the few things I've read so far this morning. So we should be getting a lot of clarity on that, at earnings calls and things like that. Right now, most of the semiconductor sector is too close to their earnings report to come out and say anything, provide anything that might even smell like guidance or an update on how the company is doing. So they're not, but I expect a lot of questions in earnings calls and things like that to be about those new export controls and how it's going to affect some of these companies. The railroad strike may be back again. The unions haven't accepted the deal and the sort of deal that was agreed to in principle several weeks ago. Hopefully that will be resolved. That would be pretty bad for just trying to get stuff here. How bad it is for the economy overall or the stock market over the longer term really depends on how long the strike is. Can't even speculate on. In the Russia situation, the market, I think, has gotten pretty used to it at this point, but there is always the potential for there to be more trouble when you have something like that. There are different things that can happen that could cause some sort of disruption or volatility in the market. So those are kind of the other things that we're watching in the market and the economy. All right, so we got a couple of questions this week, or this time around. Thank you to everybody who submitted questions. As always, you can send us a question pretty much anytime you want. You can hit the help button on the website. If it's something you want me to talk about in the workshop, just say, hey, talk about this in the workshop. You can also respond to those workshop invite emails. And also, if you have questions now, you can go ahead and just put them in the question box, and I will get to them as seems appropriate. All right, so I'm not going to pretend that I know how to pronounce this person's name, but they had some pretty good questions that seem like they're probably relevant to everybody. So I'll just run through these here. So the first one was sort of what to do when the market is acting so bad. And really, I mean, the answer is hold on, right? Like bear markets don't last forever. Selling now has a tendency to lock in losses. People's ability to time the tops and bottoms of the market is pretty bad. So that's not really a great strategy. Certainly selling now and then, I don't know what your strategy would be. Buy back in when things get back to where they are now. That way, right, you didn't really do anything that way. You can try to buy back in lower, but sometimes things turn around really fast, and it's very hard to do. So, typically, I mean, the next bullet here says you can't defend against a bear market during the bear market, and that's pretty much right. Like, if it's going to rain and you're going out, you can plan ahead and take an umbrella or a raincoat, or you can stay home. But if you're out and it starts raining, sometimes you get wet. And that's just how it goes. And this is kind of the same thing, right? Like you have to tend to your portfolio all the time. We've talked about here, and we have some articles on the website about how to rebalance a portfolio. And typically what that means is, you move some money from the things that have been winners to the things that have lagged a little bit. And then hopefully when the winners stop winning, the things that have lagged a little bit tend to perform relatively better, right? We looked at those charts early on. The tech stocks were the leaders coming out of the pandemic. They've been the leaders on the way down now, while the value stocks have held up relatively better. So if you had, while the tech stocks were running, been taking some money off the table there and putting it into things that certainly aren't as sexy or exciting or weren't going up as fast, you're doing relatively better now than you were if you let a massive portion of your portfolio become tech stocks and then now it's all going away. So you have to tend to your portfolio. It's like a garden, right? Like you have to kind of tend to it all the time. You can't be like, just show up once a year and expect to have a garden that works out well. It just doesn't work like that. You have to sort of tend to it and prune things and pull the weeds and things like that all the time. And how to protect your principal. Again, money that you can't afford to lose shouldn't be in volatile assets, right? So maybe not stocks at all, depending on how much you can't afford to lose it. Certainly not, some of the riskier stocks, right? Like if you look in the market, I mean, we can go back to that chart and look at, right, growth or value stocks are down 10% over the last 12 months, which isn't great. But the growth stocks are down 30%. So, right, there are different levels of risk, right? And certainly the growth stocks have the potential to go up faster, but they also have the potential to go down faster. Bonds are also down for the year, but they're down even less than the value stocks. Cash, it turns out $1 is still worth roughly $1. It may be worth less in terms of things you'd want to buy because of inflation, but if you're holding dollars, you still have the same number of dollars that you did before, and also interest rates are higher, so you may be doing slightly better now. Interest rates are still pretty low on most savings vehicles, but if you're really trying not to lose principal, then you're putting your money somewhere where you won't lose the principal, not putting it somewhere where you're going to make a return. Return and risk tend to be two sides of the same coin. If you're targeting higher returns, you're adding more risk to your portfolio. That's just how that works. In terms of what to buy or sell right now, there are probably some bargains to be had. But given the first two questions in terms of why is the market acting so bad and how do I protect my principal, to me, I'm looking for cash generating businesses, not just the stocks that are down the most, right? So you can say, oh, something's down, 80%. Well, there might be a reason it's down 80%. You don't just want to buy the things that are down the most because they're on sale the most. You want to actually buy things that seem solid and likely to recover, right? So when the market gets real bad, to a certain extent, people just sell everything. And sometimes the good stocks go down with the bad. So the hard work can be in figuring out which is which. And given everything we've talked about today up until now, it seems likely to me that the Fed's going to keep raising at least one or two more times, which is particularly not good for some of those unprofitable tech companies. So yeah, they're down a whole lot, but I'm still not buying those. You're looking for cash generating businesses, maybe something that pays a dividend, maybe some fixed income thing now that you can get a decent yield on stuff like that. Those are the things where I'm looking to put money right now. I'm not bargain hunting in the unprofitable tech businesses or the SPACs that went public over the last couple of years or any of that stuff that's way down. 25% off a cash generating business seems to me to be way better than 80 or 90% off something that might never actually make any money. And is it time to own some gold or silver? Well, gold and silver are also down for the year, and not just a little bit. They also don't pay dividends. They don't earn any money. There's no cash flow there. The idea is you can buy gold and silver as a hedge against inflation, except we had the highest inflation we've had in 40 years, and gold and silver are down over the last 12 months. So I don't really see any reason to hold a significant amount of gold and silver ever. It doesn't, right? If it's not a hedge against inflation, it doesn't put any cash in your portfolio. What's it doing there? Be happy to listen if somebody wants to tell me, but I don't see a reason to own it. All right, so that's those four. And then the next question we got was from Mark. This is actually kind of an interesting question. Warrants versus options. When would you choose a warrant over a call option or vice versa? So warrants and call options are functionally the same. In both cases, you get the right, but not the obligation, to buy a stock at a set price up until some date. Right, so a warrant will have a strike price and it'll have an expiration date, just like a call option. You can exercise it or not, depending on if it's in the money or out of the money. Right, if your warrant has a strike price of, or your call option has a strike price of $10 and the stock is at $8, you're not going to exercise that option. Why would you buy a stock for more than the market price? That doesn't make any sense. So you have the right to buy it. So if the strike price is at $10 and the stock is at $20, hey, I'd love to buy that stock for $10. So you can do it, but you don't have to at a set price up until some date. Okay, so the differences are warrants tend to be issued by the company. Warrants are a security that is issued by the underlying company. This means there tend to be a fixed number of warrants. It also tends to mean that the underlying shares are newly issued. So if you're buying the shares as part of exercising that warrant, you're buying brand new shares that never existed before from the company. This means that warrants tend to be dilutive to other shareholders, right? When a company issues shares, it dilutes the amount of the company that everybody else owns. Now, typically, when a company issues warrants, that dilution gets priced into the stock price then and not at exercise. So it's not a huge deal as far as that goes, but it is something to be aware of, and it is certainly a difference with options. Warrants also frequently trade over the counter, so there's less liquidity. A lot of the warrants that are out there right now were issued as part of a SPAC deal, so that most of them are listed on a major exchange, but there's still less liquidity than the underlying stock. The other big difference with warrants is there's typically a single strike price and a single expiration, right? Most companies don't have a whole bunch of warrants floating out there. They have sort of one set. So there's, for the SPAC warrants, typically there's one expiration date and the strike price is usually like $11 or $12 because they all IPO at 10. Options, on the other hand, options are their own market. Anybody can write options. I can go to the market today and say, hey, I want to sell this option. And if somebody buys it, that's a new option that didn't exist before. The company isn't getting involved at all. Also, any shares that I have to deliver as a consequence of having written that option, I have to buy from the market. So it's not dilutive. This means that you can see giant option positions open and it's not dilutive to the other shareholders because basically we're just making a contract to trade stocks that already existed. There are multiple liquid markets for options. And there's also many, many more strike prices and expiries to choose from. A lot of those SPACs from last year are trading at the ones that merged anyway, are trading a significant discount to their IPO price. And so, yeah, I mean, you can buy either a warrant or a call option that's way, way out of the money. But some of those things, the thing's trading at $4 and the warrant is struck at $11. That's almost a 200% gain to get back to there, right? Maybe you want to buy a call option at $8. And then also the expiration date. So there's many, many more things to choose from. Like I said, most of the warrants that are out there today are due to SPAC issuance. They are, in the same way that a call option is, a way to take a leveraged position. But a lot of those SPAC companies are relatively shaky. And yeah, like I said, warrants are often for more than the IPO price, while many of the stocks are well below. So really, I mean, what it comes down to is, what is the position you're trying to put on? If the warrant lines up with what you're trying to do in terms of the strike price and the expiration date, I guess you can buy the warrant. In that case, I might try to find a call that has the same strike price and expiration date and see which one is cheaper. Because if it's the same, right, if they're basically the same position, you just buy the cheaper one. If I only want a position for 2 months, or I don't want it to be at exactly whatever the warrant strike price is, then you're in options. But it's really about which, what kind of exposure it is you're looking for. Because a warrant and a call option that have the same strike price and expiration date are, from the buyer's perspective, functionally the same thing. That dilution is already priced into the stock most of the time. We don't need to worry about any of the rest of it. So they're the same. Really, the difference between warrants and options, as far as most people's trading goes, is the call options just give you a lot more choices in terms of what the position you want is. All right, that's all the questions we got ahead of time. Let's see what people have put in here so far. All right, so Jim says the bull put credit spread suggestions presented each day include technicals, such as neutral with a sideways trend. Can you talk about what these mean relative to considering the suggested credit spread? It's really there for context. So first one tends to be longer term, and the second one tends to be shorter term. So neutral with a sideways trend is basically the same thing. In the sense of, right, neutral and sideways are the same thing. So if it was bullish with a sideways trend, what that would mean is the stock over a longer term has been going up and it's been flat more recently. Right now sideways or neutral is almost as good as you can get in a lot of cases. So a lot of things now are bearish and neutral or bearish and sideways, things like that. But yeah, it's really there for context. So none of the trades are really sort of picked based on the technicals. Certainly we would like for everything to line up, but the sort of underlying situation in terms of the top part of the trade, whether it's some news item, an analyst upgrade, insider buying, unusual options activity, those are really why we pick the trade, and then we provide the technicals to you to sort of help you make a decision. It may be a thing where you're like, well, I like that the CEO is buying stock, but I don't like the stock keeps going down. I'm going to stay away from this one. So yeah. All right, Dorothy says, what do you suggest we do with today's recommended covered call, and what to do with the shares bought at exit? So, Dorothy, I think you might be a little bit confused there in the sense that with a covered call, the shares are bought at entry. So this is the trade that she's talking about here. So yeah, buy 100 shares of IJR and sell one contract of the October 21 88 call for a debit of 86.65. So the way this trade works is you buy 100 shares of the stock or ETF in this case, sell one option contract, and then if everything goes to plan, if the ETF is above the strike price, 88 in this case, it's currently at 89.68, you can sell it for 88 next Friday. But your cost basis is 86.65, so you make that, what is that, $1.35 per share in 9 days. 1.6% isn't amazing, but you do 1.6% every 9 days, it's 56.9%. But yeah, the covered call, you're buying the stock and selling the call at open, and then hopefully the stock, the option is assigned and the stock gets called away when the option expires. Otherwise, you own the shares free and clear. You can sell them, you can sell another call against them. You can just hold them. Whatever it is you want to do is fine there. Once that option expires, you just own the shares and you have a lower cost basis than you would if you had bought them at the time the trade was started. All right, that's it for the questions so far. While I'm waiting for more to come in, this session, like all of our workshops, is being recorded. It'll get posted on the website tomorrow. And we usually send out an email also letting you know that it's up there. It's just a YouTube video and a link to download the slides. And then you can also sign up for the next one, which will be 3 weeks for today, which I believe is November the 2nd. Okay. Yeah, Dorothy, I'm happy to talk more about options, but it's easier if you ask a question as opposed to just saying talk more about options, because I have no idea what it is you want to know. But yeah, if you have questions between workshops, you can reach us with this help button. That sends us an email. We get back to most of them the same day. If it's something you want me to talk about during the workshop, yeah, we can absolutely do that. Just mark it as workshop or something like that. Otherwise, you don't have to wait every 3 weeks to get your questions answered. We also have a relatively robust help center here, where you can learn about some specific things, and then we have this glossary here, so you can search, if you want to know about. That's less helpful than it could be, I guess. But yeah, we have this glossary here with a lot of stuff in it as well. It's just sort of simple definitions. All right, do you ever offer vertical put spreads? Yes, we offer vertical put spreads in a number of places. Our Investors Keyhole service, which also comes by email, will send you 4 vertical credit spreads every day. Those are put spreads. And then also in the, they look like this. So you should get an email that says, this email would say unusual options activity, call buying on Wells Fargo in the subject line, describe something that's happening in the options market, and then give you a trade down here that is typically in the same direction, although it's not, just buying calls. So in this case, we got the November 2750 by 3250 bull put spread. In that case, you're going to sell the 3250 by the 2750, both for that 3rd Friday in November expiration for a credit of 30 cents or better. We also, in the option screener, have both bullish and bearish vertical credit spreads. The bullish ones are the put spreads. The bearish ones are call spreads, because these are credit spreads, so they're out of the money calls. But yeah, there's 1,171 put spreads in here today, and you can sort by expiration date, these various metrics, how much you want to put at risk. We have no spreads, no credit spreads wider than $5. You can use our overall score, the key rating, how far out of the money you want it to be, or you can look in a particular sector or industry if you wanted to do that. On the debit spread side, we don't have vertical debit spreads for puts, but we do have a bearish diagonal spread that is a debit spread that uses puts, if you're interested in that. Okay, so Jim says, I have a bull put spread that is not working out. Can I sell both legs to get out of the trade? Yeah, so you can't sell both legs because you sold one to open. So what you're going to have to do is sell the bought leg and then buy the leg that you sold initially. But yeah, I mean, typically that is my suggestion when a bull put spread or any kind of credit spread starts to go bad is, you just close it up and move on to the next one. There's a lot of people do a lot of complicated rolling and stuff like that, but to roll the trade, what you're going to do is close this trade and open a new trade on the same stock that's further out, and typically has more money at risk. And it's never really made sense to me to say, okay, I'm going to close this position and then double down on the stock that just did something I didn't understand. It makes way more sense to me to close this position and then go find a bet that I feel better about, as opposed to, just doubling down on something that just, did something unanticipated. So that's typically how I handle those, is exactly like that. Just, close it out and move on to the next one. All right, well, that seems to be about it for the questions. Thank you to everybody who submitted a question ahead of time or asked a question during the presentation. Again, be on the lookout for that recording, sometime tomorrow. Thank you for coming today. Thank you for subscribing to Investors Observer, and I will talk to you again soon.